Welcome back to episode 7 of my Road to 100K series. In this update, we're taking a full look at where my invested money stands today and how much progress we made towards that six-figure milestone. As always, I'm breaking everything down into simple, clear sections so you can follow the journey step by step. In this episode, we're covering how much I currently have invested, the contributions I've made, the dividends collected so far this year, my year-to-date performance, and finally, the strategy and outlook that will guide the portfolio going forward. This series is all about transparency, progress, and staying consistent. So let's jump right into the numbers. This month, the total value of my investments reached $49,000, which represents 2.70% increase from the previous episode. The progress wasn't explosive, but it was solid and consistent, exactly what I want to see as I push towards the 100K goal. The number continues inching upward, and the steady growth reinforces the impact of disciplined weekly contributions and staying invested through all type of market environments. My 401k continues to move along quietly in the background. It's fully invested in the S&P 500, so the performance is tied directly to the broader market. The account now sits at $16,500, up 0.43% since last update. Even though the percentage increase is small, it reflects stable long-term compounding, and that's the purpose of this account. Slow, steady, reliable growth without needing constant attention. The more active part of my investing plan is the dividend brokerage portfolio, which has had a stronger month. The account is now valued at $32,800, showing a 3.89% increase compared to the previous episode. A combination of consistent weekly deposit and positive movement in several core positions, especially in tech and financial, help push the portfolio higher. It's a good reminder that even without major swings or huge purchases, incremental gains start to add up quickly. Overall, the blend of organic market growth and steady contributions continue working exactly as intended. When it comes to contributions, nothing changed on the 401k side. My employer still hasn't finalized the setup for my 401k plan, so contributions remain at zero for now. HR has been giving me weekly updates and keep assuring me that everything is in progress, so I'm expecting that to change soon. Once it's active, those automatic deposits will add another layer of consistency to the long-term plan. But for now, I'm simply keeping an eye on it and waiting for things to be processed on their end. On the brokerage side, everything is running as usual. I'm continuing my routine of investing $160 every week, no matter what the market is doing. That simple automated consistency is literally the backbone of this entire journey for now. Even when the market moves sideways or dip, the weekly buys keep pushing the portfolio forward and slowly increasing both my dividend income and my long-term equity positions. Looking at the top holdings gives me a clear picture of how both accounts are taking shape. In the 401k, even without new contributions, the structure remains heavily driven by large cap tech. The top 5 holdings are Nvidia, Apple, Microsoft, Amazon, and Broadcom. This is pretty much a mirror of the major weightings in the S&P 500 today, with powerful exposure to companies that dominate their industries and continues to drive market returns. The brokerage account tells a different story, focused on long-term dividend growth and quality compounding. My top 5 positions are Google, Hershey's, S&P Global, MasterCard, and Visa. These 5 names really represent the example core of my dividend strategy: strong cash flow, dominant business model, and consistent long-term performance. Google's still technically not a dividend payer. They started paying their dividend recently, but the conviction in the business makes it a foundational position for total return and portfolio growth. Meanwhile, companies like Visa, MasterCard, and S&P Global continue to compound earnings year after year, while Hershey's gives me exposure to a reliable consumer defensive name, even with recent price weakness. Together, these top positions show how my portfolio blends stability, growth, and long-term dividend potential, even as allocations shift from month to month based on contributions and market movement. Moving on, dividends have been a cornerstone of this journey from day one, and looking at the year-over-year growth makes it easy to see why. Since 2020, my dividend income has grown steadily, starting at $23 in that first year and increasing to $90, $208, $396, $537, and so far in 2025, $505 year to date. Each of these numbers tells a story, not just about the money received, but about the progress and compounding power of disciplined investing. What's remarkable about dividends is how they serve 2 key roles in this portfolio. First, they provide a tangible reflection of progress. It's one thing to watch the total portfolio value tick upward, but dividends are actually cash flowing into the account, a direct reward for holding quality companies over time. Each payment, whether big or small, reinforces the strategy and makes the journey feel real. Second, dividends act as a self-reinforcing engine of of compounding. Every dividend collected is an opportunity to reinvest, purchase additional shares, and increase the future dividend stream. Even with modest weekly contributions, reinvesting dividends accelerate growth far beyond contributions alone. The number from 2020 to 2025 clearly illustrates this effect. The income more than 20x in just a few years, showing how consistent investing and dividend reinvestment truly compound over time. This steady growth also highlights the importance of quality and consistency. Companies like Hershey's, S&P Global, MasterCard, Visa, Microsoft, and other holdings I own aren't just selected for price. They are chosen for their ability to reliably generate cash and increase dividends over time. That reliability means the portfolio doesn't just grow on paper, it grows in a way that keeps fueling itself year after year. In short, dividends aren't just a bonus, they are the backbone of this road to 100K. They provide measurable progress, fund reinvestment, and create a compounding loop that accelerates portfolio growth. Without dividends, the journey will rely entirely on capital appreciation, which is less predictable and more exposed to market swings. With dividends, every payment collected is another step forward, another brick in the foundation of financial independence. Looking at the performance year to date, the numbers tell a different story about how different parts of the portfolio are moving relative to major benchmarks. My 401k has gained 16.91%, which is slightly ahead of the S&P 500, 16.02%, while my brokerage account is up 12.57%. For comparison, the Nasdaq has surged to 20% and the Dow has grown to 11.55% so far this year. At first glance, the brokerage trailing the Nasdaq or even the S&P 500 by a few percentage points might look concerning, but there's an important distinction to understand. These benchmarks are heavily driven by large cap technology stocks, which have been massive price appreciation this year. Meanwhile, many of the companies in my brokerage account are high quality compounders with strong fundamentals, but their stock price has remained relatively flat. These are businesses that generate consistent cash flow, pay reliable dividends, and grow their earnings steadily, even if the market hasn't fully recognized their value yet. This means that short-term performance doesn't always capture the long-term story. While some of my positions are lagging a few percentage points behind the benchmarks, they continue to deliver real value through dividends, reinvestment opportunities, and fundamental growth. The portfolio isn't chasing up the latest tech hype and is building a foundation that will compound reliably over decades. In essence, this underlines a key principle of this journey. Performance measured in the short term is only part of the picture. True wealth building comes from consistency, high quality businesses, and letting dividends and reinvestment work their compounding magic over time. Even when the numbers lag a benchmark for a few months, the underlying engine of the portfolio keeps moving forward, laying the groundwork for sustainable growth and long-term compounding. As we close out episode 7, it's important to make a step back and look at the bigger picture of this journey. The strategy remains focused on high-quality compounders, companies with strong fundamental, consistent growth, and reliable cash flow, even when their stock price remains relatively flat. These are the businesses that form the backbone of a portfolio built for long-term growth, providing both stability and the opportunity for dividends to compound over time. By sticking to this approach, I'm prioritizing quality and consistent over short-term market swings. Regarding adjustments, nothing has happened this month. I continue to invest $160 per week into the brokerage account, maintaining a disciplined, steady contribution schedule. On the 401k side, contributions hasn't started yet, but HR has been providing updates, and the plan is expected to go live soon. Once it's active, I will further accelerate the portfolio growth through automated investing, adding another layer of long-term compounding. Looking at the outlook, the brokerage account is still slightly behind the benchmark in terms of year-to-date performance, but it has closed much of the gap as high-quality compounders continue to demonstrate a steady growth. While short-term fluctuations are normal, the fundamentals remain strong, and I remain confident that the portfolio is well-established position for long-term success. By continuing with disciplined investing, dividend reinvestment, and a focus on quality companies, the path towards 100K is clear and steadily progressing. So that wraps up episode 7. We're now just about halfway to the 100K milestone, and I'll continue sharing updates with you every month. If you made it this far, thank you so much for watching. If you haven't already, consider subscribing. Thanks for watching again, and I'll see you in the next one.